Hello, I'm Charles Rinehart, Chief Investment Officer of Johnson Investment Counsel. Thank you for tuning into our January market update video. 2025 is in the record books and 2026 is upon us. Before turning the page, it's worth reflecting briefly on what turned out to be a strong year for markets. Despite an almost constant stream of headlines in 2025, including major tariff announcements, renewed questions about Federal Reserve independence, and the longest government shutdown on record, markets delivered solid results. The S&P 500 finished the year up nearly 18%. International equity markets were one of the most pleasant surprises of the year, with the ACWI ex-US index surging roughly 33%, and bonds played their role, delivering returns in excess of their starting yields, with the Bloomberg Aggregate Bond Index up more than 7%. By almost any measure, 2025 was a good year for investors, and a reminder that markets can perform well even when the news flow feels anything but calm. While headline markets were strong, beneath the surface, the economic picture remained uneven. Lower-income consumers and more traditional old economy sectors largely treaded water, while investment in artificial intelligence accelerated rapidly. That technology-driven spending was enough to drive overall economic growth, with GDP expanding at 4.3% in the most recently reported third quarter. Fortunately, after several years of divergence between tech and the rest of the economy, there are signs that economic activity could begin to broaden in 2026. Lower mortgage rates, a year of Federal Reserve easing, lower oil prices, and expectations for a healthy tax refund season all provide reasons for cautious optimism that growth could become more balanced. Monetary policy remains a careful balancing act. Inflation's still above the Fed's target, but appears contained for now, while unemployment has edged gradually higher, continuing signs of softness in the labor market remain. While both markets and policymakers expect additional easing, it's likely that most of the rate-cutting cycle is already behind us. But even so, the effects of last year's easing are still working through the economy and should remain supportive in the year ahead. That support will be important because expectations are elevated heading into 2026. The S&P 500 is trading around 22 times forward earnings, which is a level that has historically been associated with periods of excessive optimism. That does not rule out further gains, but it does raise the bar for future returns and reinforces the importance of diversification and selectivity, as well as sustainable earnings growth. Looking forward, markets will continue to face uncertainty. From elections to geopolitics to normal cycles of volatility, we expect plenty of surprises in the year ahead. Our commitment to you remains unchanged. We will not allow short-term headlines to dictate long-term investment decisions. Discipline, diversification, and thoughtful planning remain the best ways to stay focused on the goals that matter most to you and your family. Thank you for your continued trust and confidence. We look forward to navigating 2026 together, and we wish you a great year ahead.